Now, I think it's going to have a really hard time getting this through Congress because most Congress people have have pretty big balance sheets. Hey everyone, Travis Spear with Pine Financial Group. Thanks for checking out our video here on YouTube. Please be sure to hit the subscribe button so you see when we put out new content. Today I want to talk to you about 7 items that could affect your real estate investing and your tax liabilities as a real estate investor or just a regular citizen. As we all know, Joe Biden's been elected the President of the United States and his term has begun, and he's fast at it, putting some legislation and executive orders into play. One thing that we have to keep an eye on is the tax reform that he's proposing. Now, this is still early and we don't know all of the details yet, but we're starting to see some of the bullet points come out, and there's a handful of items I think we have to keep an eye on as real estate investors and frankly just taxpayers, because this will affect a lot of people. So I'm going to run through 7 of them that are sticking out to me to give you a heads up of some things to keep an eye out for. The first one, and probably the biggest one that most people are seeing, is eliminating the 1031 exchange. Now, ultimately, I don't know if this is something that Congress would pass, but it's an interesting item to think about. If you're not familiar with the 1031 exchange, we have a couple of videos about it here on the channel, but it basically gives you the opportunity to sell a property you've owned for more than a year and trade that into another property without paying the taxes on the increase, so long as it's all going to be reinvested into a new property. Now, as a smaller type of mom and pop type of investor or landlord, this may not seem like it's going to affect you too much, but it certainly could if you're looking to do tax-free exchanges in the future to increase the size of your portfolio, sell some properties, maybe improve your portfolio. But where this is really going to affect the market is in big transactions. If you look at commercial real estate transactions, apartments, hotels, shopping centers, big purchases like that in the multi-million-dollar space, a lot of this money is 1031 exchange funds that are being sold from one asset that has maybe run its course and trading up to a bigger asset. And it's curious to know what the difference will be there, knowing that those taxes will now be taxed at even a higher tax rate, which we'll get to, and what would happen in the market without the ability to do that exchange. The next one, which likely affects most people, is eliminating the stepped up basis. So if you're not familiar with the stepped up basis, just as an example, if your parents owned a house that they bought for $100,000 30 years ago and they passed away and now that property was going to sell for $500,000, the way that it works today is when you inherit that property, your basis in that property is $500,000. So if you sold it for $500,000, you wouldn't pay any taxes on the proceeds. If you sold it for $510,000, your only taxable portion would be that $10,000, so you'd pay taxes based on that gain. Now, this can affect a lot of people because if your parents, grandparents, relatives of property you would potentially inherit lived in a property for a long time, especially say in a coastal city or even here in Denver, the way that prices have gone rampant over the last few years, that could be a significant difference. So without the stepped up basis, your basis would be based on what they paid for it. So your basis now when inheriting it would be $100,000, and now you'd have a taxable gain of $400,000, which would put you into the highest tax bracket. Of course, all marginal, you'd probably expect to pay at least 35% taxes on that depending on your annual income. So that goes from having a really small to no tax liability to potentially having upwards of $130,000 paid in taxes on the sale of that property. Important to know. Joe Biden also proposes taking the highest tax bracket back to 39.6. Previously, this was at 37 in the Bush era, taken up to 39.6 in the Obama administration. Also tacked on with an additional 3.8% Affordable Care Act tax surplus on incomes, I believe over $250,000. So that starts to add up too. Along with an increase to the highest tax bracket, long-term capital gains, which are traditionally taxed now in the highest tax bracket at 20%, would be increased to ordinary income for earners over $1 million. So this means if you have a long-term capital gain on, let's say, a piece of real estate you've held for a long period of time, and you sold it, your income was over $1 million, you would pay ordinary income, or 39.6%, plus the 3.8% Affordable Care Act surcharge, and then your state tax on top of that. So on an income over $1 million, you could likely be looking at paying tax rates of near 50% or more for long-term gains. The tax plan will also phase out the qualified business deduction on incomes over $400,000. If you're not familiar with this, if you own a handful of rental properties, you may have benefited from this. This gave taxpayers the ability to deduct 20% of their qualified business income, and that's going to start to be phased out on incomes over $400,000. So potential for a higher tax liability for earners over $400,000 who are self-employed or were taking advantage of that deduction previously. The tax plan also proposes to add what they're referring to as a donut hole in the Social Security taxes paid. So the way it is now, if you're a W-2 employee or you own your own business and run it as an S Corp, taking a W-2 salary, you pay Social Security taxes on incomes up to $137,000 in 2020 and $142,000 in 2021. So what this means is if you're taking a paycheck or W-2, or if you're just a high W-2 earner, you hit the cap on the amount of money collected in Social Security taxes at those $2 amounts I gave you previously. So that in 2021, a taxable income above $142,000 does not pay that 6.2% Social Security tax. And if you're self-employed paying yourself W-2, then you're actually paying 13.4%. Above that dollar amount, you don't capture that 13.4%. So it gives you tax savings. What it's going to do now is on W-2 incomes over $400,000, it's going to start to pick back up. So as a business owner, you'd pay the 13.2% on the first $0 to $142,000, and then it would pick back up over $400,000. You'd pay 13.2% on that income also to Social Security taxes. Now here's a big one, and most of the items that I'm reading online are saying that the likelihood of this passing is relatively low. But the proposed increase here would be to increase the estate tax from 40% to 45%. Which doesn't sound like a big deal. It's a 5% difference on taxes on estates over $11.5 million. But the caveat here is that not only is there going to be an increase from 40 to 45%, the amount of the estate is going to be lowered from $11.5 million to $3.5 million. So this would mean that the value of the estate over $3.5 million would be taxed at 45%. Now, I think this is going to have a really hard time getting this through Congress because most Congress people have have pretty big balance sheets and have participated in deals and grown their net worth significantly while working for the government. So I'm not sure how many people would go for this. But it's interesting to note because $3.5 million as an estate for someone who's done okay over their lifetime really isn't that much money, especially if you're on one of the coasts or something like that. And it could really eat up an estate that typically is built on assets where the taxes have already been paid on them once, federally and state, and will significantly change the ability for inheritance for their heirs or potentially even passing on to others. So that's something important to note, whether you have a big estate or your family does, or you plan to grow to have a big estate like we all aspire to as real estate investors. So those are 7 things to look out for in the proposed Biden tax plan, which will likely see hit Congress's desk sometime this year. Keep an eye out for new content that we're putting out, and keep an eye out for your increased tax liabilities as taxes change in the coming years. Thanks for joining us, and check us out at pinefinancialgroup.com.